In 1997, Warren Buffett, the world's most famous champion of buying wonderful businesses, did something he almost never does. He turned his back on stocks and bet big on a cold, hard, non-productive asset. He bought silver, a lot of it. Berkshire Hathaway started buying up the metal until it held an incredible 129.7 million ounces. Now, a lot of people today just write this off as a weird one-time trade. They'll point to his later skepticism about commodities as proof he soured on silver. But that's missing the real story. It's missing the why. Buffett wasn't just buying a lump of metal. He was exploiting a huge market imbalance he saw developing from a mile away. And in doing so, he left us a timeless playbook for spotting these rare, explosive opportunities. We're about to walk through the 3 key signals he followed and why those exact same signals are flashing brighter than ever today. To really get the opportunity here, you have to understand the trade. This wasn't a random guess. It wasn't a bet on inflation or a flight to safety. In his 1997 letter to shareholders, Buffett laid out his logic with cold, hard math. He and his partner, Charlie Munger, saw a simple, fundamental truth. The world was using way more silver than it was producing. In his own words, in recent years, bullion inventories have fallen materially, and last summer, Charlie and I concluded that a higher price would be needed to establish equilibrium between supply and demand. Think about how wild this was. This is the same guy who famously said he'd rather own all the farmland in the U.S. than all the gold in the world. And now, he was arranging to take delivery of nearly 4,000 tons of physical silver. He used the commodity brokerage Fibro to quietly make the purchases over several months, starting in July 1997, and had the metal stored in vaults in London. This wasn't some paper bet on a screen. It was a physical one. He was literally taking metal off the market. While it wasn't a billion-dollar bet from the start, the initial investment was hundreds of millions, and its value grew to approach $1 billion as the price rose. At its peak, Berkshire's holding was equal to around 15% of silver's entire global annual supply. A move of such conviction, it shook the market. But it wasn't the size of the bet that mattered most. It was the sheer clarity of the idea behind it. Buffett wasn't speculating. He was acting on a set of clear, observable signals that all pointed to one conclusion. The price of silver had to go up. And that's the playbook we're about to break down. So what exactly did Buffett see that so many others missed? It all boils down to a 3-part framework based on the physical reality of the market. Signal number 1, the massive, persistent supply deficit. This was the core of Buffett's thesis. Back in the 1990s, the world was consistently using more silver than was being produced from mines and recycled scrap combined. The annual shortfall that Buffett and others noted was often in the neighborhood of 100 million ounces. Let's make that simple. Imagine the world's silver market is a bathtub. Every year, miners and recyclers are the faucet, pouring water in. Industrial users and investors are the drain, letting water out. Buffett saw that for years, the drain was significantly wider than the faucet. The water level was going down year after year. That isn't a forecast, it's just arithmetic. When you use more than you make, you get a structural deficit. The longer that goes on, the more powerful it becomes. Buffett knew you can't fight the laws of supply and demand forever. Sooner or later, the only thing that can balance the equation is a much, much higher price. Signal number 2, the vanishing stockpiles. A steady deficit has a very real physical consequence. Inventories start to disappear. This was the second signal lighting up Buffett's dashboard. That annual shortfall had to be filled from somewhere, and it was coming from the world's above-ground stockpiles. The silver held in big bullion vaults like those of the COMEX in New York. These vaults are the strategic reserves of the silver market, the pantry everyone relies on in a pinch. Buffett saw reports that these inventories had fallen materially. The pantry was being emptied to feed the world's appetite. For instance, over the mid to late 90s, COMEX inventories fell dramatically. This is a critical sign. A deficit on paper is just a theory. A physical drawdown from registered vaults is a fact. It's the ultimate proof that the shortage is real. When that last ounce gets pulled from the shelf, the game completely changes. The price is no longer set by paper contracts, but by the desperate need for the physical metal. Buffett saw the shelves getting barer and knew that whoever controlled the remaining physical supply would have all the leverage. Signal number 3, inelastic supply and inelastic demand. This last signal is what can turn a regular supply problem into an explosive opportunity. It's a two-sided coin. First, let's talk about supply. Silver supply is famously inelastic, which is just a fancy way of saying it can't ramp up quickly even if prices shoot up. Why? Because roughly 70 to 75% of the world's silver isn't mined on its own. It's a byproduct of mining for other metals like copper, lead, and zinc. A copper miner isn't going to spend billions to build a new mine just because the price of its little silver byproduct goes up. Their decision is based on the price of copper. So when demand for silver surges, you can't just flip a switch and make more. Supply is locked in. Then you have the demand side. In the 1990s, the single largest driver of silver demand was photography. And that demand was also inelastic. A company like Kodak wasn't going to halt film production because the cost of silver in a single roll went from 50 cents to $1. It was a critical, non-substitutable ingredient, but still a tiny fraction of the total cost. They just ate the higher price. When you put these two things together, it's a recipe for a price explosion. You have demand that doesn't really care about the price, and supply that can't respond to the price. Combine that with a structural deficit and draining stockpiles, and you have the perfect storm. If you're finding this breakdown of Buffett's strategy valuable, go ahead and hit that subscribe button. We dig into market history and uncover these kinds of insights every week, and you won't want to miss what's coming next. Okay, here's the kicker. Why did we just spend all this time dissecting a trade from over 2 decades ago? Because those 3 signals from Buffett's playbook aren't just flashing again today. They're arguably flashing with even more intensity. Let's revisit signal number 1, the supply deficit. For the last several years, the silver market has been in another significant structural deficit. According to industry analysts like the Silver Institute, the deficits in recent years have often been substantially larger than the 100 million ounce shortfalls Buffett saw in the 90s. In fact, their reports projected the market would remain in deficit for several consecutive years through 2024 and possibly into 2025. The drain pipe is wider than ever. Now for signal number 2, the vanishing stockpiles. Just like in the 90s, this massive deficit is being fed by draining the world's vaults. We are seeing persistent reports of large-scale withdrawals from the major depositories in London and New York. While these inventory levels can fluctuate, the overall trend has shown a significant depletion of available physical metal needed to meet global demand. The world's strategic pantry is once again being emptied and potentially at a faster rate than when Buffett was buying. And finally, signal number 3, inelastic supply and demand. This is where the parallel gets really compelling. The supply side is just as inelastic as it was back then. Most silver is still a mining byproduct, but the demand side has completely transformed. The photography industry has been replaced by something far larger and even more critical, the green energy and technology revolutions. Silver is an essential, non-substitutable component in solar panels and electric vehicles. According to projections from groups like the Silver Institute, solar energy's share of silver demand has soared, growing from around 12% in 2022 to a forecast of nearly 29% in 2024. An electric vehicle uses significantly more silver than a gas-powered car. On top of that, the massive build-out of data centers to power things like AI is creating yet another huge new source of industrial demand. This modern industrial demand is even more price inelastic than photography ever was. A multi-billion-dollar solar farm or EV factory will not stop production because of the price of silver. It's a rounding error in their total budget, but the metal itself is absolutely essential. For them, running out is simply not an option. So you have a market that mirrors the 1997 setup, but amplified. A potentially larger deficit, rapidly draining inventories, and a new wave of industrial demand that is more powerful and more permanent than anything seen before. So what happened with Buffett's big trade? He was right. After Berkshire Hathaway's position became public, the price of silver surged. The company's 1997 annual report alone showed a pre-tax gain of $97.4 million. Some analysts estimate the total profit from the trade, which lasted over several years, was likely in the hundreds of millions of dollars. But here's the critical lesson, the one that gives us the most important context. Buffett himself later acknowledged that he sold too early, getting out well before silver hit its ultimate peak in the years that followed. This is the ultimate warning from the master himself. Even when you are 100% correct on the fundamentals of a market, timing the absolute top and bottom is nearly impossible. His silver play was never a permanent change in his philosophy. It was a specific, calculated trade based on a rare and extreme market setup. It proves the power of the framework, but it also shows the risks of playing in commodities versus owning a productive business for the long haul. The story of Warren Buffett's 1997 silver investment is more than just a fun piece of financial history. It's a masterclass in seeing what others don't. He didn't have a crystal ball. He had a framework. He saw a massive structural deficit, proving demand was beating supply. He saw inventories physically draining from vaults, proving the deficit was real. And he saw inelastic supply and demand, proving the imbalance could only be fixed by a higher price. Today, those same three signals are arguably blinking red again. The point of this video wasn't to tell you to go out and buy silver. It was to give you the framework that one of the greatest investors in history used to identify a monumental opportunity, so you can analyze the market for yourself. To make sure you don't miss our next deep dive into the forces shaping our world, hit that subscribe button and turn on notifications. The markets are always moving, and you won't want to miss what we cover next. Thanks for watching.